For millions of Americans, a 15 or 30-year journey of monthly payments represents the ultimate financial finish line. A paid-off home is the definitive marker of a stable, successful life. You write that final check or click that final transfer, and something psychological happens the moment the money leaves your account. The structure you live in drops its weight as your largest financial obligation. It becomes a debt-free symbol of ownership rather than a bank's collateral. But the next month rolls around, and the biggest bill you've paid simply doesn't arrive. A financial vacuum opens up in your checking account. The natural expectation is that you can finally relax. Your cash is yours to keep, and housing-related financial stress is a thing of the past. Yet, the absence of a mortgage payment often masks a new set of financial demands waiting right behind the front door. Wood rots, pipes degrade, and municipalities require their cut. The physical structure continues to exist in a deteriorating physical world and a strict tax system. This animated balance sheet shows the main payment vanishing, leaving only taxes and insurance. Then, unexpected physical failures create immediate financial shocks. Absorbing those blows requires a dedicated sinking fund, carving out small monthly increments to build a barrier against repair costs. For years, you passively sent one large payment to a bank that likely handled the escrow for you. Now, you have to actively construct and fund a strict housing budget yourself. Home ownership shifts from a shared responsibility with a lender to a solo management task. You now fund and oversee every dollar of the property's upkeep. At the same time, you are sitting on a monthly surplus of hundreds, perhaps thousands of dollars that are now stranded in your accounts. You have three immediate options computing for that capital: padding your emergency savings, upgrading your lifestyle with travel, or financially supporting your family. If you leave that surplus sitting without a designated purpose, it will naturally evaporate. Extra dinners out, slight upgrades in spending, and subtle lifestyle creep will quietly absorb the money. To capture that wealth, actively redirect the stream. That money needs new, defined channels into liquid savings, investments, or lifestyle spending. Pushing freed-up cash into the investment channel capitalizes on compound growth, accelerating your net worth in the final stretch before retirement. The disappearance of your biggest bill represents a mandate to become an active manager of your own capital. Zooming out to your total net worth, that debt-free property now sits on your personal ledger as your single largest asset. Locking in that home equity provides psychological comfort. It creates a solid defensive foundation, ensuring you always have a secure place to live as you age. But grocery stores and pharmacies do not accept bricks as payment. Daily living and healthcare require accessible, liquid cash. This scale visualizes the illiquidity trap. You can be wealthy on paper with a massive block of home equity, while simultaneously struggling to survive because your liquid cash reserves are depleted. A paid-off house provides a defense against housing inflation. Surviving a multi-decade retirement requires a balanced, highly liquid investment portfolio working alongside it. Reaching zero on your mortgage balance is a massive achievement that demands years of exact budgeting, discipline, and patient sacrifice. Clearing that balance changes the primary objective of your financial plan. You spent decades exchanging your labor to pay back a lender. You now have the capital to ensure your money is working to pay you. True financial independence relies on the luxury of having choices. The central question changes from how to pay off what you owe to deciding exactly what you want to build next.